To understand the leak, we need to go back, way back, before credit cards, before digital banking, before inflation became a permanent background noise in our lives. There was a time when money represented something real. Gold, silver, tangible value. If you had money, you held wealth. Simple, clear, direct. But over the last century, something changed. Quietly, legally, systematically, governments shifted from money backed by value to money backed by belief. A promise on paper, a signature, a system built not on what exists, but on what could be borrowed. And that's where the first crack opened. Because once money became something that could be created, it could also be devalued, controlled, manipulated, inflated, and eventually drained. Not in a single dramatic crash, in a slow leak. Let's rewind to 1913, a year that changed everything. The creation of the Federal Reserve in the United States, marking the beginning of modern central banking as we know it. It was sold as protection, a stabilizer, a guardian of financial safety. But with great power came a subtle shift. Now, money could be expanded, printed, issued at will. Fast forward to 1944, the Bretton Woods Agreement. The US dollar becomes the world's reserve currency, but still connected to gold. A leash that, while long, kept the system grounded until 1971, when President Richard Nixon cut the cord. No more gold backing. Money became purely fiat currency by decree. And just like that, the leak turned into a pipeline. Because if money can be printed, then every new dollar dilutes the value of the ones already in your pocket. As printing grew, inflation followed. Not overnight, but gradually. Prices rose. Wages tried to keep up, but never fully did. Savings accounts lost power. Retirement funds started shrinking in real value. People thought they were saving, but they were saving in a bucket with a hole. Meanwhile, something else was rising quietly in the background. Debt, credit cards became normal. Student loans became unavoidable. Mortgages stretched over decades. Debt wasn't a burden. It was marketed as opportunity, a tool for growth. But debt has interest. Interest demands payment. Payment drains money over time. Each loan is a slow siphon. Each interest payment, a leak. And while citizens adopted debt as a lifestyle, governments did too. National debt skyrocketed. Central banks lowered interest rates to keep the system alive. More borrowing, more spending, more money created from thin air. The rich invested in assets, real estate, stocks, businesses. The poor and middle class stored savings in cash, and cash slowly evaporated. Two worlds, two outcomes, one silent system. Decade after decade, the leak grew. By the 1990s, credit culture was fully normalized. By the 2000s, cheap money fueled bubbles. Housing, tech, stocks, everything inflated beyond reality. Then came 2008, a crisis not caused by an asteroid or a pandemic, but by the system itself. Too much debt, too much leverage, too many cracks. The world expected a correction, a punishment for reckless lending. Instead, the opposite happened. Governments printed more money than ever before. Banks got bailed out. The system didn't reset, it expanded. And the leak became permanent, because every time the system wobbles, the solution is more money creation, more currency, less real value. And the people who pay the price, workers, savers, anyone holding dollars instead of assets. Let's connect the dots. Why do things cost more each year? Why does your salary feel smaller even when it increases? Why does saving cash feel like walking up a down escalator? Because inflation isn't a side effect. It's a strategy. A quiet tax. Invisible. continuous, inescapable. If inflation is 6% and your savings earn 2%, you're losing 4% by doing nothing. Every year, automatically, retirement funds grow, but real purchasing power shrinks. Homes get more expensive, wages lag behind, education costs multiply, student debt soars. The leaks are everywhere. Inflation, taxes embedded in prices, interest on debt, currency devaluation, asset price manipulation, hidden fees, service charges, premium models, shrinking product sizes with same price. Not one big hit, thousands of tiny cuts. No politician stands on stage and says, "We are decreasing your wealth to keep the system running." But that is exactly what happens. Today, the pattern repeats. History is not rhyming. It's copying itself. Governments worldwide hold record breaking debt. Money printing reached levels never seen before. Digital currencies are on the horizon, programmable and trackable. In the US alone, the dollar has lost over 90% of its value in the last century. A $100 bill in 1930 is worth less than $4 today in purchasing power. And yet, people still save in cash, still trust the system, still believe their future is safe because the leaks are subtle, slow, hidden behind normal life. Until one day, you wake up and realize the future you planned costs twice as much. Picture a bucket filled with water. That bucket is your wealth, your income, savings, lifetime of effort. Now imagine tiny holes at the bottom, not big enough to panic, but enough to ensure that no matter how much water you add, it never fills. You work harder. The bucket remains half full. You save more. It still drains. This is how modern money works. To understand how this design was created, we go back to the early 1900s, when a handful of bankers and policymakers made decisions that would shape your financial reality today. Before that, money wasn't just paper or numbers in an app. It was value itself. Gold coins, silver reserves, something real, limited, measurable. If you held money, you held power. But the elites realized something. Real money limits how much wealth power can produce. You can't print gold. You can't create silver out of thin air. So they built a new idea. Money as credit. Money as debt. Money not backed by metal, but by trust. And that trust would later become the biggest vulnerability in the financial world. 1913. The Federal Reserve System is born. A private central banking authority with control over currency creation. From this moment, money becomes elastic, stretchable, manipulatable. Then, 1933, during the Great Depression, citizens are banned from holding gold. The government takes it. Paper replaces metal. Confidence replaces value. 1944, Bretton Woods. The US dollar becomes the world's financial anchor, but still linked to gold. The system is stable until one decision breaks everything. 1971, Nixon ends the gold standard. Overnight, money becomes fiat currency, backed by nothing but political promise. This is the moment money transforms into an illusion. A symbol. A tool that can be printed endlessly, without mining, effort, or resource. And with every new dollar printed, the dollars you hold become weaker. A silent leak is born. At first, people don't notice. Life goes on. Prices creep upward slowly. A loaf of bread from 25 cents becomes 50. Gas rises by a few cents each year. Rent inches forward like it's nothing. Inflation? The word sounds harmless. But inflation is a reversed interest mechanism. A tax without announcement. A leak that drains your wealth while appearing normal. If your salary grows 5%, but inflation is 7%, you didn't get a raise. You got poorer. Just slower. Banks know this. Governments know this. Corporations adapt, so they create the second leak debt. Credit becomes convenience. Buy now, pay later. Live, today, worry, tomorrow. But debt isn't just borrowing, it's renting money, and rent compounds. Every interest payment is value leaving your bucket. Every month you owe, instead of own, you feed the system. By the 90s, debt culture becomes the norm. By the 2000s, credit is mandatory for survival. Education, loan, home, mortgage, health, financing, car. Debt becomes a lifestyle, not an emergency. And the real winners are those collecting interest, not those paying it. 2008 exposes reality. Banks gamble with billions. Housing collapses. People lose everything. You'd think the system would be punished. Reset. Cleaned. Instead, they print more money. Stimulus packages. Bank bailouts. Cheap loans. More currency. Less value. A broken system is not repaired. It's expanded. The leak widens. 2020 amplifies everything. Pandemic hits. Jobs vanish. Money printing explodes beyond imagination. The world prints over 40% of all existing dollars in just 2 years. Your savings didn't grow, but prices did. Groceries doubled. Rent skyrocketed. Assets soared out of reach. The leak isn't accidental anymore. It's structural. Now, inflation is normal. Debt is normal. Working forever is normal. A 20-year-old today needs nearly 10 times more work to buy what a 20-year-old could buy 50 years ago. Not because we became lazier, but because the system became hungrier. The leaks today include inflation, eating, savings, taxes, embedded in everything interest, draining income for decades, shrinkflation, reducing quantity, quietly, asset prices rising faster than wages currency, devaluation disguised as policy fees. Everywhere. Banking. Service. Hidden charges. You are told to save money, but saving in cash is like saving snow in sunlight. It melts, even if untouched. You are told to work hard, but work alone can't outrun inflation. You are told to trust the economy, but the economy is designed to extract value, not preserve it. Let's put numbers on the crime. The dollar lost over 96% of its value since 1913. Minimum wage buying power is lower than 50 years ago. Average house price versus income ratio tripled since the 1970s. University costs increased over 1,200% in 40 years. Today, renting drains you. Buying traps you in decades of interest. Saving loses value. Spending increases dependency. The system is not failing. It's performing exactly as designed. Slow leaks ensure you remain working, paying, borrowing, dependent. Because a financially free population is powerful, and power threatens control. So, the leak must continue. Let me paint a picture. You sit at a table to play a game. The rules look simple. Earn money, save money, win security. But what you don't see is that the table is tilted. The dice are loaded. The bank running the game takes a small portion every time you play. 1 roll isn't noticeable. 10 rolls feel harmless, but after thousands of rolls, your side of the table is empty, while theirs is overflowing. This isn't a conspiracy theory. This is modern economics. Once you understand where the leaks exist, you'll understand why. 2 generations ago, 1 salary ran a house. Today, 2 salaries struggle to survive. Tomorrow, even 2 might not be enough. Let's rewind history to trace the leak. Before money was digital, before taxes were automatic, before debt was a lifestyle. Money was real. It had weight. It had metal. It had scarcity. If you held gold, no government could dilute it by printing more gold reserves overnight. But the moment paper currency became standard, everything changed. 1913, the Federal Reserve Act. Power shifts from metal-based money to central bank-controlled money. 1933, citizens forced to turn in gold. Confidence replaces intrinsic value. 1944, Bretton Woods makes the US dollar king of global finance. Then, 1971, a single announcement destroys the last barrier. The US dollar detaches from gold. Money becomes unlimited. Supply becomes infinite. From this point onward, money isn't created, it is manufactured. Value isn't earned, it is issued. And every new dollar printed steals value from existing dollars. A slow leak begins.